The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
An AI rally in question, a retail rally that never was, but a rosy outlook for 2025. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Dill. Welcome back. You missed NVIDIA Day.
I know. What happened? Did they win?
Stuff happened.
Oh, okay.
I mean, they semi-won, and then the stock was down, then it came back up, and now it's actually contributing a lot to the NASDAQ 100. Let's get a check in here on where we are. S&P around the highs of the session, up 0.6%. I want to take a look at tech specifically because a little bit of a tug of war between on the downside Google, on the upside NVIDIA, as well as Intuit, which reports after the closing bell today. So that push and pull kind of leaving tech a little bit floating in no man's land, but the S&P outperforming, Romaine.
Absolutely, and there's no way you can talk about the market today without talking about NVIDIA, an incredibly volatile day for that stock. The shares rallied almost 5% shortly at the 9:30 a.m. open and then slumped almost 4% just an hour into the trading session. As we speak right now, the share is now back in the green, up about 2%. A mixed earnings report creating some mixed signals out there in the price action. Analysts at Benchmark saying that they are going to stay cautious on the durability of that AI trade, with NVIDIA shares having tripled this year. But some investors out there, they actually see more breadth left in the AI rally and greater breadth ahead for a broader market surge.
We continue to think that tech is going to lead, but again, it's not going to mean that you're not going to see it broaden out. We do expect some of the cyclical areas of the market to also catch up.
Nadia Lovell over at UBS, strategist at JP Morgan Asset Management, feeling the similar vibe, saying that while there should be concern about the stock market petering out, the rally can soldier on into 2025 with sturdier and, yes, broader leadership. The primary support is what's always driven market gains, a strong economy and even stronger corporate earnings. And we'll get another litmus test on that front tonight with earnings after the bell from Ross Stores and Gap. But be mindful, their reports may be tainted by disruptive weather conditions that kept some shoppers away from the stores, and that may keep a lid on retail stocks joining any broad market rally. As of now, a basket of 78 retail stocks that includes Amazon, Ulta, and Chewy, up 9% this year. That's a third of the gains of the S&P, Alex, a fifth of the gains of the Mag 7, and 1/20th of the gains of everybody's favorite stock, NVIDIA.
Which brings us back full circle to your original point, which is tech, and obviously the market very dependent on how much juice there left is in tech. This is a chart that I'm hoping Romaine really, really likes. So the white line is the AI mentions of the S&P 500 company transcript. So the amount of times that AI is mentioned in conference calls. Then the green line is actually NVIDIA's market cap. And you can see ever since about March around 2023, both have really taken off. The stock and mentions of AI. And my hypothesis here is, Romaine, as long as the transcripts and AI is mentioned and that keeps shooting higher, shouldn't NVIDIA's market cap also be shooting higher, currently around $3.6 trillion?
The only thing better than that chart, Alex, is your hypothesis itself as we kick you off to the close. I think it's the first time we started the show with a hypothesis, but let's see if maybe we can put that to the test. Jay Jacobs joining us right now, U.S. head of thematics and active equity ETFs over at BlackRock. Jay, you heard Alex's hypothesis there. I was taking a look at your outlook here that you guys have put out, some of the big themes heading into 2025, and of course, AI and NVIDIA at the top of that list.
AI is certainly at the top of the list. You know, what we've recognized in this thematic outlook is we're still just in the first stage of AI development. We call this the build phase. This is where hundreds of billions of dollars are being spent to build data centers, to supply those with power, to buy semiconductors, and to build these kind of first generation large language models. That's before an adoption stage where you see really the commercialization of this AI, and it's before the transformational stage where you're going to see revolutionary AI products being built across the economy. So this is still early days for artificial intelligence.
Where's the profit phase? Where does that fall into it? I mean, should we be looking for that now, or do we need to wait until we get deeper into the adoption and the transformation phase?
There's actually profit at all three of these stages, just the companies that might benefit will shift. You know, right now you're seeing a lot of that profitability shifting towards the semiconductor companies. You know, now in the next stage, you might see that shifting towards those model developers and the companies that have proprietary data that will really benefit from commercializing AI. And the profit stage in the third phase, that transformation, these are companies that might not even exist yet. So what we're seeing now is still like the infrastructure layers where some of the most attractive profit is coming from.
And obviously you're head of thematics and active equity ETFs. So what kind of ETFs are a good way to play these sort of buckets as we shift through the AI theme?
Yeah, exactly. So we launched a fund just a month ago, BAI, which is an actively managed AI ETF run by our portfolio manager, Tony Kim. And he's looking at exactly that. Just what are the categories that are benefiting today, which are the ones building for the future, and who are going to be the winners in each of those buckets. So we feel that this is an area where being tactical, being responsive to the market, having that active manager that can guide through these AI shifts is going to be really important.
Jay, what other sort of buckets are you guys looking at that have some actual real running room and profitability over the next decade, for example?
Well, we've also been looking at the medical innovation space. You know, we're benefiting from a bit of a macro tailwind right now, which is interest rate cuts. Interest rate increases really hurt biotechs over the last couple of years. But now that there's cuts in place, you could see more mergers and acquisitions. You could see R&D budgets accelerating. You could also just see valuations expanding for biotech. So this is an area where our BMED ETF, BMED, is really kind of tactically looking at who benefits amid a lower interest rate environment, but also when you see just incredible amounts of innovation in medicine.
I am curious, though, Jay, on that point, though, about the drop in interest rates or the potential drop in interest rates. You also put Bitcoin in the category of an asset that actually would benefit from that drop in interest rates. Why?
So Bitcoin, along with gold, are two assets that don't generate any income. They don't pay any cash flow to investors. And therefore, if you look at more of the professional investor space, they're looking at the trade-offs between I could get 5%, risk-free interest from short-term government bonds, or I could look at non-cash flowing assets. And as interest rates come down, that gap between those two assets starts to shrink. And you see that institutional investors start to look more attractively at those non-cash flowing assets. So we've seen a good flows into gold. We've seen good flows into Bitcoin. I think a lot of that is positioning around falling rates and the attractiveness of non-cash flowing assets.
Dumb question, Jay. When you start to talk about how you're looking at 2025 and the things you're modeling, how much of that incorporates the new administration, the new presidential administration that will be in power come January 20th?
Well, look, geopolitics played a huge role in 2024. We saw over half the world's population voted for new leadership. And so this is actually a global theme as you think about public policy and how that might shift heading into 2025. The areas that we really highlight in our thematic outlook are not just looking specifically at the new administration. It's really looking at where do you see the most consensus in government for areas like infrastructure, where that's going to happen because of federal spending, that's going to happen because of state and local spending, even private spending. I just like to think about the New York area, which is, we have the 7 train extension here, which was funded by New York City. We have the 2nd Avenue subway extension, which is half funded by federal grants from the Infrastructure Investments and Jobs Act. And you have JFK Terminal 1, which is privately funded. And this is just a perfect example of how you need multiple layers of government and private investment to all come together on really kind of a consensus theme like infrastructure.
Now we just need to actually have the trains run on time, and then we'd be all good. Hey, Jay, then how do you play that particular part? I mean, is it like the shovel-ready stuff? Is it cement? Like, what kind of buckets of ETFs would make sense?
Sure. We in our IFRA ETF, we're looking at everything from infrastructure owners, more the utilities companies that are running this infrastructure. You look at companies that are providing the raw materials, construction engineering companies that will benefit from the new build-outs and repairs. You really have to look across the entire value chain at kind of existing infrastructure and the builders of new infrastructure.
All right, Jay, got to leave it there. Jay Jacobs, U.S. head of thematics and active equity ETFs over at BlackRock, kicking us off to the close here on this Thursday afternoon. A closer look at big tech and a closer look at AI with the flurry of fundraising happening in the AI drug discovery space. We're going to sit down with the CEO of Recursion Pharmaceuticals, backed by none other than NVIDIA. That's coming up next right here on The Close on Bloomberg.
All right, staying with one of BlackRock's themes, biotech. Recursion and Exscientia, 2 leaders in the AI drug discovery space, have officially combined. Chris Gibson, the CEO and co-founder of Recursion, said the combination, quote, makes us the leader of the AI-enabled drug discovery and the development space, and he joins us now. Hey, Chris, from what I understand it, you guys are really a biotech disruptor. You want to make drugs cheaper and faster. So how does Exscientia help you do that?
Well, look, today it takes over 10 years and over $2 billion of invested R&D for each new medicine that's approved. And that's because 90% of drugs that go into clinical trials ultimately fail. And we believe that's because biology and chemistry are incredibly complicated. And we believe that tools like AI on top of the right data sets, which we have been building here at Recursion and Exscientia has been building over the last decade, give us an opportunity to take AI and understand how biology and chemistry are interacting so that we can make better medicines more quickly for patients.
In terms of the macro backdrop, I'm wondering sort of the timing of all of this. And I appreciate it takes time to go through, but we are in a lower rate environment. We just talked to the head of thematic over at BlackRock, who said one of the reasons why they like biotech is because lower rates will then help, and it will help things like M&A. Chris, does this play a factor for you?
Well, look, I think Jay was right. This is definitely the build phase for AI in biotech. But biotech is a space that takes a long time to mature. And Recursion and Exscientia are two of the companies who've been at this for over a decade. We saw an opportunity to take the two leaders of the space, put them together, and really try and catapult ahead of the rest of the industry, where frankly, I see a lot of underinvestment in AI compared to many other industries. And so it will take some time for us to read out programs. We've got 10 programs in the clinic or near clinic now today, which is it's fantastic. But it's still going to take us over 18 months to read out the next 10 of those programs, the next 10 milestones. And as we do that, I think people are going to start to see the promise of AI in this space where clinical readouts are a really lagging indicator of the promise that we see.
Well, I am curious if you could just kind of explain in layman's terms, Chris, why the use of these AI tools will lead to a better end product, meaning more success, the idea of getting an actual product to market that is viable and safe. Do you have some sense here that this is actually pushing us in that direction?
Absolutely. I mean, today, every one of our phase 1 clinical trials has been successful. We've been able to decrease the amount of time it takes to get a drug to the clinic by 50%, and we've been able to decrease the cost by roughly 50% as well. And so we're seeing these leading indicators of success. Ultimately, though, what really matters is getting a drug to patients, and they don't really care if it's designed by AI or not. But these leading indicators suggest to us that as we keep generating momentum in this flywheel, the laboratory behind me is doing the equivalent of my entire PhD's worth of work every 15 minutes. And all of that data is now substrate for these AI models. And as we know from other industries, from the LLM space, et cetera, these models are just getting better and better. So we're going to have network effects all of a sudden in the field of biotech, which is something that we really haven't seen before.
There are also a lot of competitors in this space, Chris, as I'm sure you know. There was just news today on NVIDIA and some of the progress that they've made. I am curious, as you build up your own business at Recursion, kind of what ends up being the moat? Are these AI tools proprietary in some way that what you discover ends up, I guess, being just yours?
Romain, I think the real moat is the data. We've generated or partnered to bring in over 50 petabytes of data. We're moving more data to the cloud than the X fire hose was at least a couple of years ago. We're really generating an incredible quantity of data. And in the space of biotech, generating data across biology and chemistry and not focused on one disease at a time is actually a pretty rare thing for companies to be doing. We've been making that investment in this build phase, like Jay was talking about, for a decade. And I think we're going to start to see over the coming years, that's going to really start to pay off. And ultimately, no matter how much money you have to put into the AI space, data takes time. Cells take time to grow. You can't just brute force it with money. It's just going to take time to do the experiments. And I think we're well ahead of really anybody else in the space there.
Hey, Chris, your stock is at a 52-week low today. Why? What do you think is not getting across to investors based on what you said?
Look, we're playing the long game. And I think the reality is when you're building a new sector, it takes time for people to understand. We're making sure we're doing the work to help them see where we're going with this business. But ultimately, as we take medicines to patients, those medicines work for patients. I think the stock price will take care of itself. Shareholders will be happy. And we certainly will be happy as well.
So what's going to be the next sort of big date we should be paying attention to that's in your pipeline?
We've got a readout on our CDK7 program on December 9th. We've got readouts for multiple programs coming in the first half of next year. All of these, we believe, are going to be catalysts for people starting to really understand how it is that AI is going to help us bring the next generation of medicines to patients.
Chris, are you going to remain a standalone company? I know there's got to be people kicking the tires right now somewhere.
we definitely are going to remain a standalone company. We've been at this for over 11 years, and I feel like we're just getting started. I'm not tired. I don't think anybody on our team is tired. So we intend to go this alone. And this is really interesting. The biotech industry, multi-trillion-dollar industry with over 20 companies with market caps that exceed $50 billion. This is a space where it's known for M&A and consolidation, but really there's not many industries where you have that many big players. Very few of them are anywhere near as tech-enabled as a company like us. So I would say over the next decade, maybe some new players in that top 20 space.
Does that change, though, also this idea? I mean, when we talk about biotech stocks and the investability, it's always this idea that investors are basically looking for that one big home run. And you kind of mentioned this idea of using these AI tools to sort of look at the whole sort of human biology, if you will, rather than just one specific thing. Does that maybe provide a little bit more room for base hits rather than just swinging for the fences for that one big blockbuster drug?
Well, look, there's lots of companies who are going for base hits. We are going to decode biology. And if you can decode biology, you could potentially disrupt this entire industry, an industry that does, $150 billion a year in R&D, multi-trillion-dollar market cap for just the top 50 companies in the space. So I think there's going to be an Amazon or an NVIDIA of the biopharma industry, and it's a question of who and when, and we intend for it to be us.
All right, Chris, great stuff. We'll catch up with you again soon, I'm sure. Chris Gibson.
Thank you.
He's the co-founder and CEO over at Recursion. When we come back after the break, we're going to take a closer look at one of the big movers on the day, and that is Ulta, in need of a bit of a glow up after William Blair cutting its recommendation on the makeup retailer's rating, citing longer term risk in the beauty category. That's coming up next, right on Top Calls, right here on The Close on Bloomberg. All right, let's get a view from the sell side. Our top calls. These are the big movers on the back of analyst recommendations. And we start off today with On Holding. Raymond James saying run, don't walk to this stock with the upgrade to strong buy from Outperform. Excitement here about the company's year-to-date performance and positive brand and product reception in what is already a congested market. Raymond James also adding the shares to its current favorites list and bumping the price target up to $63 a share from roughly 52. Those shares right now trading at a record high. Next in line, GE Vernova, Wells Fargo, starting coverage of the power generation tech company with a buy and a 385 price target. The company saying GEV's gas business stands to benefit from an AI power surge driven by some of those data center buildouts, U.S. reshoring and electrification trends all tied to the energy transition and decarbonization goals. Those shares up fractionally on the day, but that is still good enough for at least an intraday record high. And finally, let's take a look at Ulta Beauty. Just can't get out of its own way. A downgrade today to market perform over at William Blair. The analyst saying things may not look as pretty in the long term due to the ongoing shift of the beauty market to online platforms, a transition that will surely lead to increased competition and potentially harm retail sales. Those shares down about 1% on the day. And those are some of our top calls. We do want to stick with that last one. Pleased to say that the analyst behind it, he joins us now. Dylan Carden is analyst over at William Blair. That recent downgrade on Ulta Beauty, Dylan, catching a lot of eyes for a stock that, of course, has been lagging all year long. Why aren't we seeing maybe a little bit more adoption of not only the products in the store, but more importantly, of the shares itself?
Sure. So it comes down primarily just to category softness, primarily. You had an industry that historically has grown in the mid-single digits, start to grow about 10% for 2 years. And you're just seeing normalization of the category. That moved a little quicker than the company had expected. To their credit, they called it out as a risk into this year. But your comp guide for the year has gone from 4 to 5% to now it's -2 to 0 within 2 quarters. So I think it's just moving a little bit quicker than they had anticipated. And our call is effectively that runs into 2025, whereas if you look at consensus estimates, people are looking for a little bit of a quicker recovery than we think is likely.
I am curious about their business model because when Ulta Beauty kind of came up on the scene, the whole idea was, they set up in suburban locations. They set up the stores where you could come in and test all the products. That was a big part of the feature. Physical folks coming into the physical stores here. You're saying with online competition, that appeal might not be there?
So physicality will always be a very important piece of this, right? I mean, even in our analysis, we're talking about the industry growing from 20% to 30%. that still allows 70% of the industry to be done in a physical store. The issue is that if you look back historically at other industries that have moved online to that degree, right, going from 15% to 40% tends to be the most damning period of online migration because it's in direct cannibalization of physical retail. So, you can still have a relatively healthy retail channel, but if you're starting to see higher online adoption, that can be cannibalistic. And then what you're talking about is deleveraging a fixed dollar for a highly variable dollar, which can be damaging to margin as well.
So, Dylan, this will get pushed out then in 2025, like you mentioned. What does that inflection point to the downside, I guess, look like? Like, what does that bottom look like and then that recovery?
You're talking about the category?
Yeah.
Yeah, I mean, I think what we'd expect and what's sort of embedded in our model is a low single-digit decline that kind of runs through the front half of next year. That would get you about a year and a half on the decel. If you look at other industries, eyeglasses, pet, home, you've seen about 2+ years of the downside, right? And so the risk would be is that you're still in the back half of 2025 looking at some relative weakness in the category.
But in theory, like, beauty is awesome. Invest in your face. Like, that's recession proof, right? So, like, once they get through their own transition, in theory, that should hold up.
Yeah, and I think that's why people love this category. It has proven to be more durable, particularly in recessions, like you call out. This is not to say that the category itself is somehow disadvantaged or weaker, but again, you're talking about normalizing growth on effectively 10% growth for 2 years straight, right? So you kind of have to take it all in the context of a category that should theoretically long-term be growing around 5%.
So when we talk about, I guess, the idea of whether Ulta can sort of, get its mojo back here, do you look at management and do you have any confidence that maybe they can find a way to execute through this?
Yeah, I mean, it's a different model now, and I think to their credit, they've called out that they're a more mature retailer, right? Growth is going to slow. They're starting to lean more into buybacks, which is what you would expect from a mature retailer with a nice free cash flow profile and a clean balance sheet. So I think I give them a lot of credit for acknowledging kind of where they are on the maturity curve.
Yeah.
I don't see them talking as much about what their online strategy is, truthfully. And if you go back to the analyst event that they had in October of this year, the messaging was effectively we're going to open up 100 more stores than we thought, right? So that's kind of antithetical to what we're speaking to here. So I do wonder, at some point you would think that they would want to address TikTok in particular. TikTok, I think there always needs to be a catalyst for an industry moving online, be it an Amazon, Wayfair, Chewy, whatever. Here, I think social media and TikTok in particular and tutorials could be that catalyst. And I don't see them have much of a strategy there.
Yeah. All right, Dylan Carden, thanks a lot. We appreciate Dylan Carden, analyst over at William Blair. Now I buy my actual makeup online, though.
Yeah, me too.
I don't need to go in a store.
I learned how to do my makeup. No, you laughed, but remember during the pandemic, we had to do all our makeup, and I was just on TikTok. I was on YouTube, and I got everything. Learned how to do the smoky eye, the lips,
He's all grown up. All right, coming up, David Lefkowitz of UBS will be joining us about the 2025 outlook. This is Bloomberg.
Just about 3:30 p.m. in a rainy New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. We're on the upside now. The S&P right around the highs of the session.
Yeah, you can't really keep this market down, right? I mean, we always keep talking. It seems like every day we talk about, is this the end of the rally? Have we finally sort of hit stall speed, and then all of a sudden you find a way where investors re-up?
And then we're looking into next year. And it's
already?
Like, how many calls for 6,500 and 6,600 can you pack in? A lot.
Yeah, and I think partly is, do you think that's a symptom of where we were a year ago when people were looking at 2024? And the calls really weren't all that bullish. In fact, most of them were pretty bearish, and of course, most of them turned out to be incredibly wrong.
Exactly. So what do we do for next year? So we're about a month out, and we're getting all the calls in. Now, UBS has just released their 2025 year-ahead report. They forecast the S&P reaching 6,600, 10-year yield hitting 4%, and central banks making further cuts. For more on what developments they see shaping the next stage of the Roaring 20s, I want to bring in David Lefkowitz. He is head of Equities Americas at UBS Global Wealth Management. David, it's great to see you. So the Roaring 20s is the idea is that you have lower rates, you get lots of growth, everything's going to be awesome, and you guys think that's going to continue?
Yeah, we do. If I had to take a step back, Alex, the way I would phrase it is I think the drivers of the rally that we've seen over the last 2 years, we think those are still applicable to next year. Namely, we've had durable economic growth. I think that continues into 2025. At the same time, we've seen disinflation, which has led to now Fed rate cuts. We think there's more to go in that. And by the way, when you have that combination of durable growth and Fed rate cuts, you tend to see stocks do quite well. And usually they rise for the S&P 500 close to 20% in the year after the first Fed rate cut. So that's the window we're in right now. And then the third leg of the stool is AI. And we think, clearly there's much more priced for AI opportunities now, but we still think there's more to go. So we think the main drivers of the rally are largely still in place.
So if that's the case, then what is your conviction level to the 6,600? Because I feel like everyone now has 6,500 and 6,600. So now it feels like it's consensus, and that's going to make me worried.
Yeah, I think, my personal conviction, I think we feel pretty good about it. And we just don't look at this from a top-down perspective. We also look at this from a bottom-up perspective as well. And just thinking about some of the secular drivers that we were talking about, biggest of which is probably AI. But some of the companies that are leveraged to those trends, we think those companies look interesting as well. I think you can also expand the lens a little bit and look at some of the companies that are levered to the electrification that we see going on. Some of that's driven by AI data centers, but also we have an aging grid where there's decarbonization efforts. So I think there's a number of ways to look at this.
Yeah.
Agree. I think most people are fairly constructive. That doesn't mean it's the wrong call.
Yeah.
Because if the drivers do turn out the way we think they will, we think stocks will be higher. That's not to suggest that there won't be some volatility along the way. We know there always is. We've got tariffs to contend with. There's going to be contentious budget negotiations.
Yeah.
So there's plenty of things to think about.
Let's think about those things a little bit more in depth, David, because I am curious, because all of the things we had on the screen, all of the things we're talking about are unique in one particular element, and that's government involvement to some degree or another. A lot of those things aren't going to happen without government help, or at least with the government not getting in the way with regards to any sort of onerous regulations. How much confidence do you have heading into a new administration, heading into a new Congress in January, that they're not going to be an impediment to that growth that you're talking about?
Yeah, I think this new administration is largely focused on trying to get government less involved in the economy. And yeah, there could be less support for things like renewables and things like that. But, I would also bear in mind that a lot of companies have decarbonization goals. A lot of state governments and local governments are in the same boat. So to the extent that, usually government getting a little bit less involved tends to stimulate growth a little bit. I think there's still some uncertainty that companies, consumers and businesses have to contend with, and that has to do with tax policy, spending policy, and things like that. But, in general, I don't think the government involvement is going to be much of an impediment.
So when you look at the potential risk out there, at least the risks that need to be factored in, what are a couple that are kind of rise to the top of your list to keep an eye on?
I think probably the biggest risk is if we see inflation really moving the wrong way. This rally that we've seen over the last 2+ years has really been predicated on substantial improvements in inflation, and there still is a little bit more to go. And those improvements have prompted the Fed to start cutting rates. Mm-hmm. If we start to see inflation moving the wrong way, i.e. moving up, and that could happen because of mismanagement on tariffs. It could happen if the economy just runs a little bit too hot. There are risks there. That's not our base case. I think that's certainly one thing to worry about. And then look, a lot of this market has been driven by AI. And to the extent we see any disappointment there, we don't think we will. We think we're going to see another year of healthy growth in 25. But clearly that would be something that would be troubling as well.
So, David, it was interesting. BlackRock, Bridgewater, knew it was a B there, was talking about just that point in terms of higher inflation, and that potentially you could wind up seeing a Trump pick for Fed chair that's okay with higher inflation and also will cut rates. Does that set us up for a dangerous environment going forward, or do you think that will be able to then extend the Roaring '20s?
I think it's all about a matter of degrees. I think if we're talking about inflation running 2.5 to 3. Look, long-term inflation in the United States, has been closer to 3 than it has been to 2. So if we're talking about something like that, I think that's fine. If we're talking about something higher than that in the context of still Fed rate cuts, I think you would start to see the bond market sending signals that they weren't necessarily as comfortable with that. The Fed doesn't have as much control over the long end of the curve. You could see long-term interest rates rise as long-term inflation expectations rise. So some of those policies might end up being counterproductive if they let inflation run too hot. A little bit above the formal Fed target, I think that's very manageable. But a lot above, that's a different story, I think.
You guys are looking at investment grade bonds, also diversified fixed income strategies and equity income strategies. So it's all about getting that income. Where on the curve or where in corporate credit would you like?
Yeah, so we do like investment grade. We've gone, we're not really willing to extend out much on duration right now. We do think rates eventually come down towards the at some point over the course of 2025. But we want to get more confidence in terms of the Fed rate cuts, in terms of the outlook for tariffs and things like that. So, don't want to extend duration too much, but at some point, it could be more interesting to do that.
David, great stuff. David Lefkowitz over at UBS Global Wealth Management. The outlook for 2025 as you count you down to the closing bells here in 2024. When we come back, a closer look at what's been going on in the world of crypto and shares of MicroStrategy taking a big hit after Citron Research said it shorted the stock. It's our stock of the hour. We'll discuss coming up next right here on The Close on Bloomberg. All right, welcome back. It's time now for our stock of the hour. We're taking a closer look at shares of MicroStrategy, taking a big leg down on this Thursday afternoon after Citron Research announced it's betting against what is effectively a crypto company at this point. Citron cited the reason behind shorting MicroStrategy being that investors can now buy Bitcoin ETFs directly instead of using MicroStrategy as a proxy. Abigail Doolittle joining us right now to talk a little bit more about what's going on here. And I think we should just clarify, too. Andrew Leff made it very clear. This is basically a pairs trade. He's still bullish on Bitcoin and crypto overall.
Correct.
But he feels a sense to hedge given the big run up. And he feels like MicroStrategy is the best way to hedge that to the downside.
It's hard not to see his point, given the fact that this stock is up 700%, more than 700% over the last year. Over the last nearly 3 years, it's up more than 2,400%. So huge gains. It's a truly parabolic uptrend, all because they are playing hedge fund manager and buying Bitcoin. I mean, they own 1% of the world's Bitcoin supply. That equals 331,000 Bitcoin, thereabout. That's as of November 18th. So he's saying, yes, you can buy Bitcoin. You can have that exposure that you couldn't have before right through the Bitcoin ETFs. And by the way, if you want to hedge what is likely going to come back down overall, that MicroStrategy would be the better way, since MicroStrategy has gone up so much more on a percentage basis than Bitcoin.
I see. So buy a Bitcoin ETF instead because you have more upside that just came out versus this.
Well, not that you have more upside, but you have access to Bitcoin through the ETFs as opposed to through MicroStrategy.
Aside from that, though, I'm wondering, in terms of MicroStrategy, do we see is there a technical level that you need to be watching here? Because
so it's already collapsing.
It's already collapsing.
It's already collapsing. And I actually did, of course, make a little chart for us, which shows that it's likely to collapse, I believe, down closer to 300 or so. And we can take a look at why that is.
Because, do we have that chart or no?
Let's see if we pull it up. That's up to the control room.
So it's going to collapse based on what?
It's going to, I'm pulling up the chart right now. So essentially a parabolic uptrend is a 90-degree angle. Per physics, it cannot hold. The trend into the parabolic uptrend that came on the election was really, and there's a look at that parabolic uptrend. I mean, you don't have to be a chartist to see that that's not going to hold. So it's basically going to go back down toward the trend. If folks are lucky, that'll be around 250, but you could even see it go closer to where it had been earlier this year. What goes up must come down. But, Andrew Leff's not the first person to say this. I mean, there's a 15% short interest on this thing, and earlier this year, Carriesdale said that they were shorting it. Now, they they've been through a lot of pain. But some of these short investors, when they really have a lot of conviction on their trade, they add on the way up. So I'd be curious to know what their position is.
I am curious too, but we've been here before where a lot of people have looked at MicroStrategy and said, look, I mean, this is going too far, too fast. And MicroStrategy has certainly had its lows, but it's always seemed to bounce back. And,
it does.
I don't know. I mean, I feel like, whatever you think about Michael Saylor and the strategy, taking a hard bet against it is.
Do you know what? The first time I went on an institutional desk back in 2000, it was actually February 29th of 2000. MicroStrategy was at like 400 or 500. And then about 2 weeks later was the peak. And then MicroStrategy a year or two later was, I think, like, $50 or $20 or something like that. At that time, it was just a software company. It was just the BI.
Well,
but look at it now. It's
I'm
made
old
this
enough
recovery.
to remember. Petra Farms remembers when it was actually a software company.
Yes, exactly. And it still is. It still is. Go to the website. Go to the website.
All right, Abigail, thanks a lot. Really appreciate that. I should point out that Bespoke has a note out just crossing right now that says that even if you strip out the existing Bitcoin holdings from the market cap, they still see the remaining businesses valued at $70 billion. And we're about $86 billion. So they don't see that much loss left on the end of the day. We had some 52-week highs. Did you realize this? In the S&P, we got a lot.
I did. Take a look at them. Quite a few,
Walmart, all the big financials. Also, I wonder what's going on with them.
And this is exactly, I think, what we heard from Nadia Lovell earlier on the open interest. This idea here of a broadening of the rally, and anyone who's doubting that broadening, it's there. You just have to look.
Yeah. Well, coming up, we're going to talk to Kristina Hooper, Chief Global Market Strategist at Invesco. Where is she looking? This is Bloomberg.
What we've recognized in this thematic outlook is we're still just in the first stage of AI development. That's before an adoption stage where you see really the commercialization of this AI, and it's before the transformational stage where you're going to see revolutionary AI products being built across the economy.
Jay Jacobs over at BlackRock kicking us off to the close just about 50 minutes ago, talking about his big themes for the future. And of course, AI and NVIDIA really baked into that outlook.
And infrastructure and Bitcoin. I feel like that's going to be on everyone's bucket list.
And is he wrong? I mean, we don't necessarily know what the gains are going to be, but when you look at where the puck is going, that seems to make the most sense.
It's a really good point. And today, the puck is definitely going into the green. The S&P is up by 0.6% around the highs of this session, but it's interesting in what leading it. So S&P Financial is one of the leaders, up 1.5%, but also utilities also taking the helm. But that still feels like, is it safety or is it cyclicality or a little bit of both?
I think it's interesting, though, to see the Russell 2000, S&P 400 mid-caps, Dow Transports back in the mix, because it seemed like the gains that we saw, those post-election gains, really just got completely erased. And then the last couple of days, they seem to have found a little bit better footing.
And again, it's the broadening of the rally, right? So it's just a matter of how much do you buy into that and when?
Absolutely. Let's pose that question to our next guest as we continue to count you down to these closing bells. Just about 8 minutes away, and Kristina Hooper joins us here in Studio 2, Chief Global Market Strategist over at Invesco. An eye on today, and of course, an eye on 2025. We've been talking a lot about that, Kristina, and I am curious about kind of the biggest risk that investors should kind of keep their eye on as we head into, or I should say, out of a record year in 2024. I mean, I don't want to jinx it. I know we still got a month to go, but most people think this is going to be a record year, and we're going to possibly have a record 2025. What's the risk, though?
So I think there are actually a few key risks. One, of course, is the resurgence of inflation. And that can certainly be fanned by pro-growth policies. That can also be fanned by a very, very restrictive immigration policy that shrinks the labor pool. It can also be fanned by, for example, tariffs if they're applied for a significant period of time, and especially if they're quite large. The other risk I would point to is the potential for a Liz Truss moment. The idea that we are finally hitting that breaking point where bond vigilantism comes and drives up yields because there are not as many willing Treasury buyers out there. And I think that is a real risk. 2024 was our first year in which the line item in government spending for servicing our debt was larger than our entire defense budget. That's not sustainable over the longer term. And I think we're seeing greater fears. We've seen the 10-year yield go up because of a variety of factors, but I would say one of them is because of concerns about a lack of fiscal prudence.
Yeah, and it seems like most of the mainstream economists, when they're kind of assessing some of the policy proposals, if they were to be implemented, those debt levels and those deficit levels are certainly going to rise. The question is there not the potential for some equilibrium that even as the government's balance sheet maybe weakens a little bit, if there is a net positive effect on the economy and ostensibly the stock market, should investors be comfortable with that?
I think they should. I think this argues for diversification. I think all the uncertainty we see looking out is certainly significant, but they're also very significant opportunities. And so the best approach, in my opinion, the most prudent, is to be well diversified, both across and within the three major asset classes. That way we can protect against or hedge against some of the biggest risks and also take advantage of a variety of different opportunities presented by this environment.
The Liz Truss moment was interesting because I keep reading more and more about how the cost of leverage is now increasing as swap spreads fall because the back end of the curve keeps kind of rising and staying sticky, and that the funding, like the pipes, aren't going to work as well. When you take a look at it in terms of the catalyst then, what do you think is going to be that moment, and how do you sort of trade that?
Well, it's hard to see how that moment comes. I think what we're seeing now is, hey, here are some yellow flags. These are things that investors are worried about. But it could very well go in a different direction. Certainly if we see more discipline when it comes to fiscal spending in 2025, I think there's certainly a concern that a red sweep means that there won't be those controls. But if, for example, tax cuts are fully funded or almost entirely funded, I think that certainly takes down yields. I think that takes down the anxiety around this. I think we're a long ways away from a Liz Truss moment. This is an environment in which we have significant GDP growth. There's a lot going for this economy. There's a lot going for the government. I think investors just want to see signs that the government is going to be careful and do a little more to control spending.
So how does that affect the broadening out of the rally call that many have?
So I don't think it has a dramatic impact, because I think in general what we're seeing is that financial conditions are easing, and that's supportive along with improvements in real wages. And that's a big part of our outlook for 2025 that's driving a reacceleration in the economy, is that consumption improves because we see real incomes improving, real wages improving. And so from my perspective, I think we are going to see that rotation into cyclicals, into small caps. They are more sensitive to the economic cycle. And I think what we're going to see is a pretty strong reacceleration in the U.S. We're also going to see reaccelerations in the U.K., in the Eurozone, in Canada, the major developed economies. I think we also have the potential for a nice reacceleration in Japan, just given that those wage growth, what we've seen in wage growth is sustainable and could improve from here.
I'm curious, what's your advice to investors out there, to potential clients who look at the run-up that we've seen in the U.S. market? They're concerned about valuations. They're concerned about chasing a rally. And they say, is there anything outside the U.S. borders? Or is this primarily going to be 2025 a U.S. market story?
Well, I think there is legitimate concern. Valuations are stretched in the U.S. But if we dive down, valuations are not very high when it comes to small caps and when it comes to cyclicals. So, a rotation of some degree within one's U.S. allocation makes sense. And then abroad, there is a lot of opportunity. UK equities, very low PE ratios, high dividend yields. I think there's the potential for a nice reacceleration. Rate cuts should help there. Fed easing should be very supportive of emerging market equities and debt. So I think there's a lot of opportunity in areas where valuations are lower. I think as we enter the end of the year, this is a time to be rebalancing, taking profits, reallocating, redistributing. That doesn't mean walking away from tech and the mega caps, but it just means being better distributed.
What's that going to look like, though, for you? I feel like this year is going to be much crazier given the outsized gains that we've seen and how concentrated some of those gains are going to be. A lot of people are really going to have to rejigger their portfolios in a certain way.
Even modest rejiggering is going to help in terms of increasing exposure to small caps, taking some profits off the table. I think tech has long legs, but we're unlikely, in my opinion, to see tech outperform small caps and cyclicals in the near term. So just a small level of profit taking and rebalancing can make a significant impact on portfolios.
Kristina, always a great conversation. Always great to have you here in studio. Kristina Hooper, she's the Chief Global Market Strategist over at Invesco. Counting us down to these closing bells, Alex. So we only got about 2 minutes or so until we get there here. Green across the screen. It's a pretty strong day. And again, as to what she was just talking about with regards to small caps and cyclicals, it's their time to shine once again today.
But on the flip side, you do have some stock, obviously decliners within the S&P, but it does feel idiosyncratic, right? Like Google is the worst performer in the S&P, but that's very much a DOJ and Chrome story. Amazon also might be probed under the EU Digital Markets Act. So that's, again, sort of idiosyncratic rather than the macro feel at the end of the day.
Yeah, and kind of interesting, too, when we talk about kind of, at least for right now, kind of the dormancy that we're seeing in the yield space. Your 10-year still camped out below that 4.5 level, a level that a lot of people think we're going to go back above, and some people, of course, calling for 5. The VIX was elevated earlier in the day, and I can't remember what the dollar is doing, but we continue to see relative strength there as well.
Yep, exactly. I guess my question going forward is, what's the catalyst for the end of the year? Because everyone said it was NVIDIA. It's the most important event for in the end of the year. And then we got through it, and it's over, it's done. Yeah. Nothing really happened that bad. And then now what? Like, is it really going to be about the Fed? Is it going to be about the Fed maybe skipping December? Or is it just going to be about, let's get through the end of the year, let's see what the actual tariff situation is?
I think there's a reason why everyone's looking forward to 2025, because that's, if you're looking for any clarity, that's really where you're going to get it. I mean, so many of these big themes that we talked about with Kristina, with Jay Jacobs, and David Lefkowitz, all are kind of government induced to a certain extent, or at least the government is going to have a role in the success of those trades.
But here's my thing. If we're all playing infrastructure, we're all playing power, we're all playing AI, we're all going to play Bitcoin, isn't everyone just going to be in the same stuff all the time?
Yes. That's called the U.S. stock market.
Isn't that bad? I don't know. Don't you need the diversification?
All right. Well, yes, to answer your question here, as we get the closing bells here in New York on this Thursday afternoon, we should just point out a redhead crossing the Bloomberg terminal right now on Apple. Apple aiming to launch a revamp of Siri in 2026 that will include more in-house AI. That is the headline. We'll get you some more details on that in just a bit as we get the closing bells. Apple shares in the red on the day, but the rest of the market looks like it's going to close out in the green. The Dow Jones Industrial Average up more than 400 points, or about 1% on the day. The S&P 500 adding roughly about 32 points, or about 0.5%. The NASDAQ composite, we're just going to call it unchanged on the day. It is in the green, up about 6 points. The NASDAQ 100 faring a little bit better, up about 74 points, or about 0.4%, while the Russell 2000 is going to close out the day up by 1.66%. That's basically your outperformer on the day, at least among the major indices. Romaine Bostick here alongside Alex Steele. Joining us right now in the television studio is Scarlett Fu here in Studio 2. As always, Emily Grafeo also joining us today to kind of walk us through the gainers and decliners on the day. But let's start first, Alex, with the broader market details.
Yeah, we got into it, though. I want to point out those shares crossing, those results crossing, I should say. Earnings and net revenue, nice beat here. Adjusted earnings per share coming in $2.50. That's a beat. Net revenue estimates also coming in $3.28 billion. That's also a beat. The stock was also at a 52-week high headed into the earnings. And on a broader sense, you're taking a look at its outlook. They see second quarter adjusted earnings on the high end coming in $2.61. That is a miss, though, from estimates.
All right. We also have NetApp reporting results as well. This is a hardware storage company. It says that second quarter net revenue of $1.66 billion, slightly higher than what was anticipated. EPS was $1.42. That is up from the same time last year of $1.10. The outlook shows net revenue at $1.61 billion to $1.76 billion. That the consensus estimate was for $1.68 billion. And the full year adjusted EPS forecast also moves up a bit as well. It now sees full year adjusted EPS of $7.20 to $7.40. Previously, it saw $7 to $7.20 a share. The stock bouncing around a little bit, but currently lower by 1.5%.
Shares of Ross Stores also bouncing around a little bit in after hours trading. Those earnings out right now after the bell. Comp sales in the most recent quarter up about 1%. The street was looking for a gain of about 2.5% here. EPS coming in at $1.48. That is a beat over street estimates of $1.40, and overall sales $5.07 billion, up about 3% year over year, relatively in line with estimates. And here's your forecast for the fourth quarter. The company says EPS will be in a range of 157 to 164. Previously, it had a range of 160 to 167, and that puts your full year EPS range at 6.10 to 6.17 cents a share, a slight narrowing of what they had before. Shares up about 4 to 5% right now and in the after hours trade. Emily?
You look at some of that commentary for Ross Stores, and what they said was that their low to moderate income customers continue to face persistently high costs on necessities, pressuring their discretionary spending. We believe we should have better executed some of our merchandising initiatives. So it's always interesting what the macro read is when you think about the retailer earnings. So what does that mean? They should have
put more stuff on sale, basically?
I guess so, yeah.
Well, everyone loves a sale. But the other thing is, and this is something analysts have pointed out, Ross Stores is very much like a California-focused store. And so they don't have as many weather issues as stores that have a lot of branches in the East Coast, where the warmer than expected weather really does dampen sales of clothing during the fall.
Well, sorry, just on that point, though, too, and I haven't seen it in the release. There was some concern, though, because remember, they have a huge presence in California and Florida, as you said. But remember, we had those big storms, particularly in Florida. It's not quite clear if that actually affected this earnings, but we'll take a closer look.
They did say. Yeah, in their press release said the combination of that severe weather during the quarter from hurricanes Helene and Milton, along with unseasonably warm temperatures. So, fair enough. This is when weather actually really does count.
Yeah, because usually when retailers are like, oh, yeah, the weather, it's not like, really? Really, we didn't buy pants because it rained like that one day during the quarter. Nevertheless, though, I mean, we are looking for a better read here. And Emily, you could come into this conversation because we're waiting to hear from Gap. And of course, there's some idiosyncratic nature to that story, obviously a potential turnaround story. But it does get to this idea of what people are spending on. And I would think Ross Stores, and even a Gap, particularly with this Old Navy brand, would actually benefit in an environment where the consumer is being more cost conscious.
Right, that people are moving down the spectrum, perhaps moving away from, I don't know, maybe moving away from a Target, because even those earnings were really, really rough. But I mean, you think about spending. I was looking at Deere today, and that's one area where farmers not really spending that much on new equipment. They said that people were using used equipment, and so they didn't exactly see a turnaround yet in farmers pivoting away and buying
that's going to get a lot worse, though, if you think about it. If you look at trade wars, for example, right? So there's going to be tariffs and trade wars that are going to affect corn and soybeans. You're going to have China buying more soybeans from Brazil, and that's going to wind up hurting farmers, and it's going to get worse and worse. And how do you possibly have visibility on what that's actually going to be?
Yeah, the reaction in the stock price is so interesting, right, Emily? Because it rose 8% on the day.
Less bad.
Yeah, not as bad as the worst case scenario. Even as everyone says, 2025 is probably going to be pretty horrible.
Yeah, biggest intraday gain since 2021, but that was basically the overall analyst reaction. Better than feared. Analysts said that expectations were already really low. So the net income forecast, even though it missed, it was still better.
Yeah. What about some of the other stocks that were moving today? I mean, there were a lot of interesting stories in the cash session today, and I know you were keeping an eye on some of those.
Snowflake soaring the most in 4 years. It was up 35% overall. Good earnings. Their sales outlook beat. They're doing some acquisitions, and they're going to make large language models from Anthropic available on the platform. But that stock was down 35% this year. So I guess a little bit of a turnaround story. There were some really low expectations heading into the earnings report. So maybe the opposite of Deere. And then I was also looking at Netflix. That stock up not as much as 35%, only about 1%, but they got an upgrade over at Bank of America. The analyst said that they see a knockout opportunity in live events. This, of course,
Netflix?
This was coming after
their
fight, their streaming fight,
which was all
between
glitchy.
Jake Paul and Mike Tyson. It was the first ever live streaming sporting event. But yeah, that's right. It was glitchy. But this analyst at Bank of America is optimistic that they have a knockout opportunity. Maybe they just wanted to write an analyst note.
Well,
with
to be
pun
fair,
in
it did hit a 52-week high today, the stock. So there is that at the end of the day. What else are you looking at?
Okay, so decliners, I'm looking at Google. Their Alphabet shares tumbling today. The Justice Department proposed major changes to Google. This is a story that obviously you guys have been following. This includes a forced sale of its Chrome web browser. It was the biggest drop since January for Google, down 5.8%.
This is also one of those stories that I'm always perplexed by because is there any sense here that this investigation will continue into a new administration? I know there's been a lot of talk about how the incoming Trump administration has a lot of the same animosity towards big tech as the Biden administration did, but that doesn't necessarily mean they're going to continue, and they're certainly not going to have the same personnel and staff. We already know that they had under the Biden administration.
But J.D. Vance, he's a fan of the current FTC
Where is
chair.
J.D. Vance? I haven't seen him around. Like every time I look up, I see Uncle Elon jumping around, doing his X
He was accompanying Matt Gaetz through the halls of Capitol Hill.
That's what J.D. Vance was doing?
Yes, and then that's when Matt Gaetz ended up withdrawing his nomination. He chose to
spend his time with Matt Gaetz.
I don't know that he chose. Maybe he was asked to.
Maybe that was just
interesting.
But to your
Are
point,
they friends?
TBD.
They are now.
But TBD. But in terms of Google, what I do find interesting is that if you remember,
are you moving us along?
I am. When Donald Trump spoke with John Micklethwait, he said he wasn't going to go after Google. So, but that doesn't mean that Google can't do sort of back end work to kind of just make the issue a lot more palatable.
Or that Trump won't change his mind.
Oh, or that too. That's a great point. I did. I moved this along, and now no one takes the ball.
All right. Emily Grafeo, of course, helps us cover everything stocks here at Bloomberg News. Alex heading off into the sunset. Scarlett stepping in for her. We're both sticking around here to break down all of the aftermarket action as we wait those earnings out of Gap. And, well, a discussion, believe it or not, about Thanksgiving here in the U.S. is just 1 week away from Turkey Day. And who better to talk to about it than with the CEO of Butterball. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. Another interesting day on Wall Street with the markets really getting their mojo back after a little bit of a dip last week here. We talk about a Russell 2000 up for a fourth straight day, but more importantly, a third straight day of outperformance relative to the broader market. 1.7%. You put that up against basically an unchanged NASDAQ composite and the S&P 500 that was only up 0.5%. And maybe that's the broadening that a lot of people were really wanted to see. You see that reflected in the drop in the Mag 7 here on this day, but keep an eye on some of the other asset classes out there because this isn't just a story now about stocks and bonds. It's a story about gold, which continues to push higher, and it's a story about Bitcoin, which still continues to test that $100,000 milestone.
Getting ever closer. And as a result, we're keeping an eye on crypto-related names. Normally, MicroStrategy would be a beneficiary of crypto moving higher, of Bitcoin surging. However, because of the CEO's strategy to spend billions of dollars on Bitcoin, it's become this proxy for Bitcoin overall. Citron Research's Andrew Left says he's shorting this stock because there are easier ways to buy Bitcoin. For instance, through ETFs that track the cryptocurrency rather than buying MicroStrategy. So that's stock down about 16% on the day. Alphabet losing about 5% is the biggest decliner among the Magnificent Seven names. The DOJ, of course, recommending that the company be forced to sell its Chrome web browser following that court decision that Google monopolized online search. And a big gainer on the day here, Deere up 8.1%. This is a one-year high for the stock. This is even after the company gave a disappointing forecast. Its full-year forecast actually missed by a wide margin. But the thinking here is that the worst is in 2025, and the farm industry has brighter skies ahead in 2026. Now, our top story this hour is the cautious U.S. consumer. American consumers deserve credit for helping drive better than expected economic growth these last few years, even in the face of rising prices and higher borrowing costs. A soft landing is now very much the consensus, with few people talking seriously about recession. But the big numbers do mask a healthy dose of caution. Corporate earnings make clear that shoppers are seeking value and trading down to lower-priced goods and stores, while household savings are slowly being depleted and credit card debt is growing. So later in the show, we'll be diving into the latest earnings reports out of the Gap and Ross stores, along with checking in with the CEO of Butterball, the world's largest turkey producer. Romaine?
Very timely discussions here, and let's focus in on some of those big themes as we head into 2025, whether it's the retail trade, whether it's the big tech trade, or really everything in between. Lara Castleton joining us right now, U.S. Head of Portfolio Construction and Strategy over at Janus Henderson Investors. And Lara, we've been taking a long look at that Mag 7 trade, which really drove the broader market. I mean, you talk about the Philadelphia Semiconductor Index up 20% on the year, and S&P 500 up 25% of the year, but that doesn't compare to that basket of 7 stocks, which continues to be the biggest outperformer, at least among major names. Does that continue next year?
Romaine, thank you for having me. And I think yesterday NVIDIA's earnings just kind of proved out that those big 7 names they're kind of there for a reason. These companies continue to generate extremely strong earnings growth. They have wonderful trends and moats around their company and business models. In client conversations, we're definitely talking about the need to continue to own these companies, but you started to see a broadening of the market actually since July, pre-even election, and that is what we're more focusing on for 2025 because none of our clients only own NVIDIA and very few only own 7 stocks.
Well, good point. So let's talk about the broadening. Where are you seeing that broadening? Where is the biggest opportunity amongst that broadening?
I think the biggest topic of conversation has been small caps, small and mid cap companies. That's been a trend that we've talked about for a very long time. If you look back to that July soft CPI print, the equal weight S&P has actually outperformed the cap weighted by over about 500 basis points. Why? Inflation has come down. Interest rates are coming down. 42% of the Russell 2000 is floating rate debt, so that's a beneficiary if rates are going to be on the trend lower. And in general, we are, as you mentioned earlier, in this soft landing narrative backdrop that is conducive to maybe some more risk taking, but in a cautious way. So small and mid caps are an area that we really like going forward and should continue.
Just a quick mention here of Gap, which just reported its earnings. Let's give you the numbers for the third quarter. EPS of 72 cents, beating the consensus estimate by wide margin. That was 58 cents. Total comp sales rose 1%. That is lighter than what was anticipated, which was 1.7%. But for the outlook, Gap has raised its outlook for fiscal 2024 net sales. It also sees fiscal year gross margin of about 220 basis points higher, whereas previously it only saw a gain of about 200 basis points. And in terms of full year net sales, it sees a gain of 1.5% to 2%.
Yeah, it's kind of interesting, too. The CFO in the release talking about how August was particularly strong, primarily because of the back-to-school assortment in her words. So we should point out, though, that the CEO, Richard Dickson, in that same release, looking forward, raising some concerns here about what could potentially happen with tariffs. Of course, an increase in tariffs would have a huge impact on Gap's business, saying that they're monitoring, but right now they don't need to update their forecasts just yet. On that point.
Yeah, and this is a big question mark for so many of these companies, especially those that have to import their goods. Lara, how are you thinking through the impact of tariffs, especially these retailers, which I know have made a lot of effort to diversify their global supply chain, but it's not so easy to stop importing completely. And some companies, a Gap, will probably be more sensitive to tariffs than, say, a Ross Stores or a TJX.
Yeah, look, I think there's a lot of headline risk coming in from the new administration and the proposed policies. If we're talking to our clients about how to position going forward, we're really trying to coach them to get back to the fundamentals of the market. And that's going to be a stock-by-stock story. That means that there will be companies that will be better set up to thrive no matter what happens with tariff policy going forward because they have better balance sheet strengths. Cost of capital is no longer zero. This is fundamentally a stock picker's market, and we're coaching our clients to really try to separate the headline noise from what really matters going forward.
You had mentioned small caps earlier, and I want to go back there because small caps are seen as probably more resistant to the impact of tariffs because they're so much more domestically focused than the big cap companies. Within the small caps, we know financials are very influential in that space. Is that where you want to be, or are there certain sectors that are more better positioned than others?
Absolutely. Great question. Actually, a couple of the sectors that we really like, one is the financials, because those companies in general were benefiting from a non-zero interest rate environment already, plus proposed policy could be a boon to financials going forward. Industrials is another one that's been a trend and has had tailwinds since the COVID pandemic of deglobalization, reshoring supply chains. That, again, is a trend that could continue with new proposed policy. Maybe a little bit more controversial, but healthcare, particularly in those small cap biotech opportunities. For clients that are looking for innovation, healthcare has some of the most innovative companies outside of the tech sector. Still think that there are some fundamental opportunities there.
Well, we just actually spoke with them a little bit earlier, just about 40 minutes ago. We had the CEO of Recursion Pharmaceuticals on, which has been using AI to kind of facilitate and speed up that process of drug discovery. When you look at kind of the melding of some of these themes, I mean, we kind of talk about them as separate. AI is one thing, infrastructure is another, healthcare and biotech a whole nother thing. But there does seem to be a lot of overlap there that investors, I would think, Lara, would be looking to, right?
Absolutely. I think everybody is looking for those secular trends for the next coming years, not just that quarter by quarter trade that's going to work going forward. When you think about constructing a portfolio as a whole, it is about capturing these trends in a diversifying way. And so those couple of sectors of industrials, balancing out with financials, and then healthcare, maintaining some defensive posture are a way that clients can access these things, but still maintain a diversified portfolio.
Lara, really appreciate your joining us today. Lara Castleton is U.S. Head of Portfolio Construction and Strategy at Janus Henderson Partners. Coming up, we're going to dive deeper into those results from Ross and Gap with Mari Shor. She is Senior Analyst of Equity Research at Columbia Threadneedle. You can see both stocks moving higher in the after-hours trade following their results. This is The Close on Bloomberg. We're keeping a close eye on retailers. They are in the spotlight with shares of both Ross and Gap climbing in after-hours trading following their latest results. Joining us now is Shor. She's senior analyst of equity research at Columbia Threadneedle. And we can take these kind of one by one since they both have different narratives attached to them. Mari, I want to start with Gap, which reported third quarter comparable sales that missed analyst estimates, yet it did raise its sales forecast ahead of the all-important holiday shopping season. How much of this is tied to just expectations linked to the new management and the turnaround that he's trying to effect at the Gap?
Yes. Thank you for having me. I think the move after hours that we're seeing in both Gap and Ross is really a relief rally on the heels of Target reporting. Investors were very nervous about the sales and margin performance. And even though there was some negative impact from warmer weather, which we have all felt, the results for Gap and Ross were really no worse than feared. And I would specifically highlight the 3% comp at Gap, which is incredibly impressive. And to your question, I think it really is a sign that some of the new product and marketing initiatives under the new CEO are working. And also the company's focus on operating discipline is really working to drive stronger margins at the same time.
You said no worse than feared, and that's kind of been a theme here for a couple of the retailers, and also I think about Deere, which had a pretty terrible outlook as well, and yet the stock rallied. And you contrast that with NVIDIA, which was not able to get the benefit of the doubt even after it raised its full-year forecast. What does that say about investors' expectations on these consumer-dependent companies in this current environment?
Well, I think investors have been very nervous throughout the third quarter between the election overhang and the warmer weather, as I already described. But putting those two arguably transitory periods aside, the apparel category has been a relative outperformer, and I would expect that to continue. We're seeing a lot of newness happening in fashion apparel, and that is really resonating with the consumer. And I think the companies, for the most part, are doing a good job of controlling their expenses and inventories. Yeah. So as we move into the holiday period where we would expect the consumer to come out and shop, I think some of that nervousness is getting brushed aside and investors are able to refocus on the company's specific fundamentals at this point.
And it's kind of interesting, too, when we talk about better inventory management, and even in the release we just got out of Gap, we had a comment in that release about concerns about tariffs on China, but in that same comment, they also made it clear that their reliance on China for their goods has dropped pretty dramatically, something like down from 22% to roughly about 10% of their merchandise. I know that's one company, one particular company, but are you seeing that more broadly across the space? Better inventory management, and more importantly, kind of steeling themselves for any potential disruptions in that international supply chain?
Yeah, I mean, for a couple years now, the companies have been very focused on protecting margin, even at the expense of sales, given the weaker macro backdrop. And that's exactly what we're seeing on the inventory line, where companies are very focused on managing inventory to protect gross margin, even at the expense of sales. As it relates to sourcing exposure to China, you're absolutely right. For the Gap and for a lot of the other apparel retailers, most of those companies have exposure less than 10% at this point to China. So I do think they do have some flexibility to move around there. The categories in the retailers that have the greatest exposure to China, where I would see the greatest risk going forward, would be home-related categories like furniture, consumer electronics, and even for some of the dollar stores. So for the most part, I think that the apparel retailers are better positioned than some of those other categories within discretionary.
I am curious, too, on that apparel side, kind of this interesting phenomenon we're seeing where a lot of legacy brands, if you will, apparel brands that we kind of thought were dead have sort of found a way back. One of the best performing stocks this year is Abercrombie & Fitch. Who knew? One of the best performing stocks, even better than Abercrombie & Fitch, is Boot Barn. Who knew? Williams-Sonoma even at the top of that list. Is this kind of the trend we're seeing where those brands that maybe fell out of favor, didn't necessarily have the same buzz, if you will, have finally got that mojo back?
Absolutely. We see it is possible with some of those companies you just mentioned. I would even highlight like a Ralph Lauren to add to that list. And I think it's really a combination of one, better product and marketing execution and really making those brands relevant for a younger consumer, but also strong operating discipline. Because as we know, if these companies are not managing their businesses well, we're not going to see that upside on the sales and margin line that those companies have been able to generate. So I think it is really important for the retailers to have both that product and marketing execution, but also very strong operating discipline to drive the kind of upside that you just highlighted.
All right, Mari, you're going to have to leave it there. Mari Shor over at Columbia Threadneedle Gap share is now up 13% here in the after-hours trade. Ross Stores up more than 5% here, maybe a positive development when it comes to the consumer. When we come back, we're going to talk Thanksgiving. We're going to talk turkey with the CEO of Butterball. This is Bloomberg. Welcome back. We're 1 week away from the Thanksgiving Day holiday here in the U.S., where we all gather with family and friends and, well, some not so good friends for a day of overeating and, well, turkey. 1 out of every 3 turkeys served on Thanksgiving is produced by Butterball. So joining us to discuss what consumer trends he's seeing ahead of the holiday is Jay Jandrain. He's the president and CEO of Butterball. Great to have you here. Of course, 1 week away from Turkey Day, and I guess it's fitting that, of course, you are the man in charge here. And I am curious just about the tradition of turkey overall and whether you've ever seen any sort of cracks in that tradition, whether it's with increased costs or maybe just people wanting to try different. Like, what keeps turkey at the center of people's tables this holiday season?
Well, thanks for having me. It is certainly something that people are used to for years. We've seen it very consistent. In fact, this year, in talking to consumers, they told us about 86% of those that we interviewed plan to celebrate the holiday, which is pretty consistent with what we've seen in the past. The gatherings will be large this year, about 9 people on average, which is great to see that back. All the post-COVID situation that we had to deal with. We've got larger groups getting back together, people celebrating the holiday. And the great news for us, obviously, at Butterball is that 87% of those who will be celebrating will have turkey at the center of the table. So we're very excited about that. Great numbers from those that we talked to, and we're already seeing that in the results already at retail.
I am curious, though, whether you have any concern here about some of the price pressures that consumers have been feeling. Of course, the cost of everything, more or less, is higher than what it was over the last couple of years here. And I'm wondering if that does have any impact. Do people make choices then about what they're going to put on the dinner table next Thursday?
They do, and we know that that's top of mind. That was one of the things that consumers told us they were most concerned about coming into this holiday. And actually, for the last couple of years, inflation has taken a tremendous toll on folks. We understand that. And as a result, we've been working really hard with our retailers, particularly this year, to make sure that we've got a real value at the table for consumers. And we're seeing that in the prices so far. The feature pricing that we're seeing across the board looks like it's lower than it was last year. That's great news for the consumer. We're seeing brisk sales as a result of that, fortunately. And we also know that the turkey itself is probably one of the best values they're going to get on the table at roughly $1 per pound when you purchase it in the grocery store. It's hard to find another protein that's going to give that type of a value for consumers. So we're really proud to be a part of that.
So the turkey itself might be at a better value point than it was last year, but what about all the trimmings? I mean, you don't have any control over the pricing of everything else that goes on that Thanksgiving Day table. And I imagine if the prices of those items are going up, people will feel compelled to perhaps make some adjustments to how much they spend on the main course, the turkey.
They're not changing the turkey, that's for sure. What they're telling us is that they plan on making changes to the sides that they add. And you're right, some of those other items have gone up. Fortunately for the consumer, the turkey has not. So they may save some money on the sides. They may purchase less of paper goods. Mm-hmm. They're finding other ways to cut corners and save a little bit, but they're not compromising on the turkey, which is great news, obviously, for Butterball.
Let me ask you a question that's away from inflation, Jay, which is what's the latest innovation in turkey prep? I feel like deep fried turkey became a thing maybe 10, 15 years ago, and that's no longer new. What's the new way of preparing turkey?
Well, I'll tell you the new thing right now is our cook from frozen. That's a new product that we're rolling out this year. It's in a limited test consumers can go on our website and find our store locator that'll tell them where they can find the product. But it's a great item in that it allows you to go directly from the freezer straight to the oven. You don't have to thaw the product out ahead of time. So it does a couple of things. One, it can make it a little bit easier for those cooks who have been cooking for years and want to find a little bit of a break. And it's also great for new hosts as well. So if cooking that turkey at Thanksgiving is a little intimidating for them, well, this makes it very, very easy. Come right out of the package, right in the oven, take it out when it's done, and that's all there is to it. So we're really excited about that. We've gotten great response from it so far, and we're looking to expand that next year.
What's the science behind? I mean, what did you have to do to sort of make that where you didn't have to thaw? Because I mean, I think for a lot of us, that's like the worst part of the turkey is like realizing you forgot to thaw the turkey, and now you only got like 12 hours to cook the thing.
Well, I'll tell you, we got a great R&D group who put a lot of research in behind that. We talked to consumers to best understand what's important to them. And we're able to come up with a product that delivers on it. That's one of the concerns we had going in. Was the product going to be tender and juicy like our Butterball turkey is in our other forms? And the great news is that it is. It does deliver on the promise, and our consumers have been very happy with it.
The other thing that you offer as a service to your consumers is the Turkey Talk Line. You staff it with experts who can help people with any kind of turkey emergencies they have, not just on Thanksgiving Day, but in the days leading up to it. Does AI play a role here at all?
No, we keep that a person-to-person transaction. We're in our 43rd year of the Turkey Talk Line. Very excited about that. But that's the magic of the Turkey Talk Line. It is not an automated line. It is a real person that callers are speaking to when they call in. And we've got folks who have called year after year. I think to some degree, some of them are just reaching out to talk to that person, and they'll even ask for special Talk Line people by name. It's really a unique situation. It's something you don't find these days, but that's something we're really trying to make sure that we have the human connection, allow people to talk to somebody else on the other line, and really not just give them answers, but understand their needs and help coach them through it.
And there's this tradition to that. We only have about a minute left here, Jay, but I want you to speak directly to a certain family member of mine who shall remain nameless. We're hosting Thanksgiving, and she proposed this crazy idea that we eat something other than turkey, that we just do a chicken or fish or something like that. And I was like, what? I mean, this is like, if there's any day of the year where you commit to cooking a whole turkey, this is it. And maybe Christmas, maybe Easter, but this is pretty much it, right? I mean, what do you have for those people who maybe say, I want to do something different. I'm tired of doing turkey every year. What's your message to them?
Well, my message would be, hopefully you're eating turkey more than once a year to begin with, but you're only having the Thanksgiving meal once a year. And why not go out and make sure that you can do something that's going to make everybody happy, that's full of tradition, that people look forward to, and don't compromise on this one big special day.
All right. We're in agreement on that, Jay.
All right, Jay Jandrain, good luck to you the next 6 days. I know it's crunch time for you. Jay is president and CEO of Butterball. We started this hour with, of course, a slew of after-hours earnings. Let's just give you a recap of what we've learned from them. Ross Stores boosting its full-year EPS forecast. That stock higher by 7%. Similar story for Gap, which lifted its outlook just before the holiday shopping season. That stock up even more, 13% gain.
Keep an eye on Alphabet. The share is down about 1% in the after-hours trade. This on the back of two news reports, primarily one coming out of the information that OpenAI is preparing a, quote, frontal assault on Google with regards to its browser. And it's already spoken with several companies, including Redfin, Eventbrite, and Booking Holdings, and Priceline about helping with that effort. We'll keep an eye on that, and we'll keep an eye on the shares. Keep an eye on us right here on The Close on Bloomberg.
It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Fidji Simo. She is the Instacart CEO, and she says Wall Street undervalues the grocery tech bet. She spoke with our Emily Chang on the circuit. Yeah, take a listen.
And we were kind of the poster child for an unprofitable company. So really the way I reset with the company is to say, let's kind of forget about, what the external world is valuing us at, and let's talk about building a generational company.
That is a French accent there, so
it is.
Listen carefully.
I'm a little confused, though, by it. I mean, this is an $11 billion company, and if you put it up against peers, and it's hard to find apples to apples peers in this space, but if you look at other delivery companies, or even look at other grocery companies, I mean, it seems fairly valued.
It seems fairly valued, but if you compare it to what it was at before the IPO, it was valued at almost $40 billion. So it's seen quite the drop-off. And part of that is because Americans are going back to the grocery store to buy
because there was
groceries.
A pandemic where we had no choice but to rely on Instacart and its peers to buy things. And some of us, we like to, dump the cantaloupe and, pick out our meat.
Orange, put it back, right?
Turkey, make sure the turkey is what it's supposed to be. So,
so they're trying to expand and offer e-commerce services to supermarkets.
Oh, good for them. All right, I'm keeping an eye on Carson Block. Remember him? Short seller. And he's seeing trouble out there for apartment complexes, particularly in the Sun Belt. This is an interesting call because he talks about this idea of how everyone's focused on a commercial real estate market in the office space being in trouble. But he's looking at negative cap rates in the apartment complex space, particularly in those Sun Belt states, and I guess potentially seeing opportunity. Not quite sure if he has a trade position around it, but certainly raising the alarm.
I think he's just warning them, warning everyone about it, because a lot of landlords took on floating rate loans to modernize the properties, and we know what's happened to interest rates since then.
Absolutely, yep.
All right, third on the docket is Gary Gensler. The Securities and Exchange Commissioner said he will step down as Wall Street's top regulator at the very, very end of the Biden administration. He said he will serve through noon on January 20th when Trump will be sworn in as president, which means he might still have time to do some stuff between now and then.
Okay. I mean, this isn't a surprise. I mean, it's like if he didn't step down, he was basically going to be kicked out. So
yes, but people thought maybe he would step down early.
Yeah, Gary Gensler. I like this guy. I've known him for years. Used to cover him, but, needless to say, he's become probably one of the most vilified people
I think
on
that's
Wall
a good way
Street
to put it.
right now. All right, the top 3 honorable mention right now is the yet-to-be-named Treasury Secretary in that incoming Trump administration. Hedge fund executive Scott Bessent, Apollo's Mark Rowan, and former Fed Governor Warsh are among the leading contenders. Those close to the process say that a choice could be announced at any minute. Bloomberg Balance of Power co-host Joe Mathieu joining us right now. Joe, since I gave that intro, I don't think we've learned who the Treasury Secretary is going to be. But do we have any sense? Because the Trump administration, or I should say the Trump transition team, they've been pretty quick to put out names for some of the other cabinet and advisory positions. But this one, they seem to be taking a little bit more time with.
This is true, and you're right. Normally, we don't get this many names this quickly, so we have maybe a bit of a distorted view. We're all expecting this to be done. As Gary Cohn reminded us this morning on Bloomberg Surveillance, Donald Trump did not assemble his economic team in the first administration until the week after Thanksgiving. But yes, we are waiting for something any moment, and that's partly because they had a big round of interviews. It's like late season Apprentice here, Romaine. All 3 were interviewed at Mar-a-Lago yesterday. Mark Rowan even flew from Hong Kong for the conversation, so we thought maybe we're on the verge of something here. But look, this is clearly important to Donald Trump after running an economic-driven campaign, and it's something that he's very concerned about the markets appreciating here. We've got 3 boxes to check. This person has to appeal to Wall Street, has to appeal to MAGA, and also has to be TV ready, the central casting thing that Donald Trump talks about. That's a pretty tough test.
Well, they all look the part, more or less, right?
Some people look the part more than others.
Yeah.
And definitely Trump has his, ideas of who looks the part. We know that he's made some controversial picks, whether it's the Health and Human Services Secretary nominee, RFK Jr., Matt Gaetz, who's since been withdrawn or has withdrawn himself as Attorney General. Is Trump likely to go outside that short list and maybe pick someone unconventional for Treasury Secretary as well, given that he hasn't made a decision yet?
It would be very on brand for Donald Trump, right? We just don't know. We didn't mention, although we did show for a moment there, Bill Hagerty, the senator from Tennessee, who was with Donald Trump and Elon Musk at the SpaceX launch this week. That got people in a lather again to think, geez, maybe, he's kind of a sleeper candidate in this case. But look, it's going to be a chance for Donald Trump to make an impression different from some of the folks you mentioned. Doesn't want to repeat Matt Gaetz. Pete Hegseth is having his day in the Senate today right now, meeting with senators. These are controversial picks. He wants the markets to embrace, not freak out about the name.
I'm going to play devil's advocate. We got these 4 men on the screen. There's one choice on there that I think anybody, who's sane in the head would say this guy should be the Treasury Secretary. And I think you know who that is. And it gets to this question, though, of the litmus test of loyalty to Trump or loyalty to the MAGA cause, whatever that loyalty test is. There's also another question here, Joe, about this idea of whether that person is going to carry out the policies. We've heard from various news reports, including from Bloomberg, as well as the Wall Street Journal, that a big criteria that the Trump transition team is looking at is support for Trump's tariff proposals, raising those tariffs, and whether he would have a Treasury Secretary who would go along with it. At least two of those people we saw on the screen, at least publicly, we don't think probably would.
Absolutely right. And Mr. Bessent has sat right at this desk, and we have spoken with Senator Hagerty about this before, professing the potential benefits of this construct of tariffs and tax cuts. They espouse the idea of growth and rising revenues. And if this is Scott Bessent we're talking about, we won't be surprised. But there are also other roles inside the White House. You think National Economic Council, you think National Economic Advisors. These are roles that Scott Bessent could play as well. So I would think about a couple of different potential hats here. We still have a couple of roles to fill. Yeah. And with regard to tariffs, look at what happened in the Commerce Department, putting the trade rep beneath the Secretary of Commerce. We know what Mr. Lutnick thinks about tariffs, so maybe that takes a little pressure off the Treasury.
All right, good stuff. Joe Mathieu, Bloomberg Balance of Power co-host. He will be back at the top of the next hour with Kayleigh Lyons to take you through all our political coverage. But we want to kind of stay on theme here with politics because our next guest warns that Trump's economic plan can't just be nostalgia. Even if the U.S. could somehow bring back the manufacturing economy of half of a century ago, it wouldn't be an improvement. And the writer of that column is Allison Schrager. She's a Bloomberg Opinion columnist, and she joins us now. So, Allison, when we talk about how it wouldn't be an improvement, the whole idea behind Make America Great Again, Trump's, tagline essentially is that you want to go back to a better time when the economy was good, when people had stable jobs and they didn't have to worry about their retirement because they had pensions. Your point here is that a manufacturing-driven economy was not as great as it sounds now.
Yeah, in a lot of ways, the economy has never been better. So, people romanticize the 1950s, 60s economy when manufacturing was about 30% of jobs. But I think we forget, first of all, that was only 30%. And it was not a very good economy for a lot of minorities, for a lot of women. It wasn't nearly as inclusive. And to be honest, as I said, a lot of people didn't benefit from this. This sort of unionized manufacturing economy was a very insider-outsider economy. So we also had much, much lower living standards. Like people romanticize this, on a single job without a college degree, you could support a family. Well, people lived in a lot smaller houses. They didn't send their kids to college. They didn't really travel. They didn't have a lot of consumer goods. Women were largely at home, spending a lot of hours doing very arduous housekeeping. So it's really nothing to go back to again. In fact, right now is probably the best economy we've ever had.
Why didn't that message resonate on the campaign trail? Because you did have at least one political party, the Democrats, that seemed to be trying to make that point. Obviously, they didn't make it well enough. And then you had Trump and the Republicans going around saying, no, the economy isn't that great, and we will make it better by maybe rolling back some things.
Well, I think in terms of the campaign trail, you could note down, in a lot of ways, things were worse in the last couple of years because inflation came back. So you could look to, say, 2019 and say that was better. But Democrats also sort of run on a lot of nostalgia. Biden particularly wanted to revive manufacturing and wanted to revive unions. And I think it's just a very sort of snappy political campaign of, people always romanticize the past.
But there is some legitimacy, though. That's idea of what was lost, right? And there are a lot of folks that look at those manufacturing jobs. They look at the union power that they had, and they feel like that's been lost. So when somebody comes, whether it's Biden says, look, I'm going to be the most pro-union president ever, or Trump says, look, I'm going to tariff the heck out of everybody and rebuild our manufacturing sector, I can understand why that resonates with a lot of people.
Yeah, though it really wasn't so great. It wasn't great for a lot of people. And even in those jobs, a lot of those jobs weren't as good. A lot of sort of service jobs definitely pay more. They actually offer more stability in terms of tenure, in terms of wage stability. Wages are more stable than they were in the 60s. A lot of people don't realize that.
Where was that economic boom then, though? Because it's not just what the jobs were then. People look at the aggregate growth in GDP and the economy, and they say, that was boom times. How does that compare to what we've seen over the last, 20, 25 years?
Well, we did have big growth and we did have big changes in living standards, but it's still better now. Wouldn't you rather live in the economy today than the economy in the 60s? I'd rather live
I would not like to go back to the 60s for a lot of reasons.
I wouldn't even want to go back to the early 2000s.
Yeah.
So, the narrative is compelling, though, right? Because right now people are really kind of obsessing over how much everything costs and how much things have changed just in the last 2 or 3 years, whereas that just harkens back to a simpler time overall. Now, when Trump says he wants to, when voters say they want to go back to a period where things were better, a lot of times they're talking about pre-COVID as well. When you look back at the Trump administration 1.0, what worked the first time around?
Well, a lot of it was there were a lot of it was just the natural business cycle finally recovering from the financial crisis, which took a long time. But also there were things about the tax cut that did work, particularly encouraging companies to do more innovation. So, I mean, if you are looking at his treasury picks, a lot of them are sort of more reminiscent of the Steve Mnuchin type of treasury that he had before. So I think I hate tariffs like most economists, but I think it's important to distinguish what he's using them for. I mean, when he talks to the more J.D. Vance wing of the party, he's talking about let's use tariffs to bring back something from the 60s, as opposed to when you hear more of his treasury picks, who I guess are rationalizing tariffs for their own political reasons, they tend to focus more of we can use this as a bargaining tool to have better trade agreements. So I guess it depends what we're really going to use them for is what's going to matter.
Which is why there's so much focus on who he's going to pick as his Treasury Secretary, because you're not quite sure which wing of the Republican Party he's looking to satisfy.
Yeah.
Who would you like to see in the Treasury Secretary role?
Well, I mean, I think they're all good. I've only ever met Scott Bessent, so I guess I've liked him. So I guess I'm partial to him just because I know him personally, not well, but so I mean, but I think they're all.
Is he funny?
He was funny.
Yeah.
Is he TV ready?
I think he's TV ready. He's got a good tan.
But you look at them. I mean, you look at Mark Rowan. I mean, he seems obviously like, I guess in any other world would be an obvious pick. But even when you go down the list, you look at Warsh. I mean, you think, okay, there, and then I don't know who else with Haggerty is on that list as well.
Well, the first three I think would all be fine. Yeah. Like they'd all do a good job. Yeah. I think they'd all calm markets. They'd all be fine.
Yeah, just fine.
Great, maybe even great.
Okay, there you go.
Maybe.
Look at that. It pulled it out of her. All right, Allison, and you're not in the running, just to be clear. Maybe one day.
I'm too anti-tariff, alas.
Allison Schrager, of course, we'll keep her for now here at Bloomberg Opinion. The show continues on. We're going to set you up for what to watch over the next 24 hours when we come back after the break, right here on Bloomberg. As we wrap up our coverage here on this Thursday afternoon, let's set you up for what could potentially move the markets over the next 24 hours. And we're going to start overnight U.S. time, 3:30 a.m. to be specific, Scarlett. If you're up, you can hear from ECB President Christine Lagarde.
Right. And this is a central bank that's focused on one thing, which is fighting inflation. And you have a lot of governing council members talking about how the ECB should lower borrowing costs at every meeting until it gets to a point where they reach a neutral rate.
Yeah, it's going to be interesting to see how these central banks continue to deal with this rate easing cycle that the market, of course, is already priced in fully. Back here in the U.S., we do get a read on economic data at 9:45 a.m.
Yeah, we have S&P Global PMI, services PMI, and manufacturing PMI. Manufacturing is still below the expansion line, so it's in contraction mode, whereas services is seen holding up fairly well.
We get UMich sentiment data at 10 a.m. And then your favorite, Scarlett Fu, Fed speak, but only one.
Michelle Bowman.
Yeah, what's happening?
I'm guessing they're going to say they're data dependent.
Are they all taken off for Thanksgiving already?
Maybe.
They're in their quiet period. All right, Michelle Bowman, we'll bring you all the coverage right here on the close. But stick around. Balance of Power is coming up next, right here on Bloomberg.